Okay, so good evening, everyone. I'm excited to be here today, addressing you all as we embark on a journey of knowledge and exploration in this webinar titled Dynamic Asset Allocation Strategies for Changing Market Conditions. I'm your host for today, Sania Chavan, and it is my honor to guide you through the enlightening session where we have the privilege of hosting such a distinguished panelists. Now, let me introduce our panelists who bring a wealth of knowledge and experience to the table. Firstly, we have Mr. Akhil Chaturvedi, Chief Business Officer at Motilal Oswal AMC, with an impressive tenure of over 23 years. Mr. Chaturvedi is a maestro in mutual funds, investment strategies, and financial planning. His insights are sure to provide us with valuable perspectives on navigating the complexities of the financial landscape. Next, we are honored to have Ms. Renu Maheshwari, our very own CPAC committee member and co-founder of Finscholarz Wealth Managers LLP. Ms. Maheshwari is not only the first individual SEBI RIA in Tamil Nadu, but also boasts a remarkable 25 years of experience in the field. As a co-founder of Finscholarz Wealth Managers, she brings a wealth of practical knowledge to the discussion and is a celebrated figure in the personal finance advisory. Our discussion will be skillfully moderated by Mr. Anshul Srivastava, Associate Vice President, Standards and Certifications at FPSB India. With his expertise, Mr. Srivastava will ensure that our conversation flows seamlessly and we extract the maximum insights out of our panel. Without further ado, let's make this webinar a collaborative and enriching experience. Once again, thank you all for being a part of this transformative session. And let's dive deep into the world of dynamic asset allocation strategies for changing market conditions. Over to you, Anshul.
Thank you, Sanya. Good evening, everybody. And again, a warm welcome to our esteemed panelists from FPSB India. And a warm welcome to all the participants of the session. So today's, without further ado, I'll start. And today's topic is quite interesting. In the world of finance, and especially in the journey of investment, asset allocation plays a very important role. And over the years, there have been several researches and reports which have emphasized the importance of asset allocation. Now, today, we are fortunate enough that we have two very learned people from both sides of the table. On the one hand, we have an asset manager, and on the other hand, we have a financial planner. So I would say that Akhil would be representing the people who are making the products, and Renuji would be representing the financial clients. Not saying that it is not an opposing view, but yeah, so that's really quite an interesting thing. So I'll start the discussion with my first question would be you to Akhil, is that we are talking about asset allocation, and every student who goes and studies finance and every one who is talking about finance talks about asset allocation. Okay? So what is the importance of asset allocation from the point of view of an asset manager, and what are its determinants in this case? And as the asset classes which are giving returns also keep on changing. So what is the role and importance of asset allocation that you see in the fund management and the portfolio management?
Yeah, thanks, Anshul. Good evening to everyone. It's a pleasure talking to all of you. So yes, I think interesting panel and interesting topic. So on your question, Anshul, see, on a holistic basis, financial planning or within financial planning, I think the larger goal for any financial planner is to do asset allocation. Now, principally, asset allocation is nothing but diversifying your investments into multiple asset classes with a low correlation, such that you can diversify your risk and accordingly you can commensurate on the rewards. So as simple as that, whatever money you have, you put into multiple asset classes, and then over a period of time, every year, some asset classes will do good, some won't do good, but you will average out, and overall your portfolio will remain healthy and grow consistently and end up meeting up your goals. Now, as an asset manager, what we do really is create building blocks for financial planners and investors. So when they are doing their overall asset allocation, typically between choosing between equities, fixed income, and gold, and nowadays you have several other options like silver, etc. We provide building blocks by giving you products within each of these asset classes, and then once you have really decided that how much you want to put in each of these asset class, then you can pick and choose from asset managers like us, variety of products. So on one hand, we do create building blocks or products to meet your asset allocation goals. On the other hand, for those investors who are doing it on their own, or they want a bundled product, where largely they are dependent on the asset manager to do the asset allocation for them. So then asset managers also have created a variety of solution-oriented products, very popularly known as, there's one very popular category which is called the Balance Advantage Fund category. Now, this is the category which largely plays between equity and debt, and dynamically rebalances the portfolio between equity and cash depending on the valuations of the market. So any equity investor, when wanting to invest in equities, will want to invest more when the markets are down and less when markets are high, right? So most asset managers, including ourselves, have a variety of valuation models. We use those valuation models to ascertain whether markets are expensive or cheap, and then accordingly dynamically rebalance the portfolio, right? So that's one kind of a solution which is available from the fund managers. Now the other category which is building up very fast, and this month itself we've seen multiple new fund offerings also. So more and more asset managers are launching products in this category, is a multi-asset fund category, or multi-asset allocation fund category, where you get to participate in all the three asset classes, which is equities, debt, and gold stroke silver. So let's put it commodity that way, right? So now you have multi-asset allocation fund with all the three asset classes spread, depending upon again using the valuation models, whether it is 30-40% debt, 30-40% equity, and the rest would be gold, silver. So you have these options, solution-oriented options available. And for people like Renu or probably yourself, when you are doing financial planning on behalf of investors, then obviously you can pick and choose the building block products which we have, whether it's a large cap, mid cap, small cap, ultra short term. I mean, there are hundreds and hundreds of products. So those are some of the things which we are doing. And just to conclude on this topic, I would say that financial planners, or certified financial planners, those who do financial planning, they are like, I would say, in a simple analogy, very popular analogy actually, is they are like doctors, right? So and investors are like patients, not literally. I mean, you're all well, but just to understand very simply. So there is a problem which the investors have, and then like doctors, the financial planners try and address those problems. And when they are addressing the problem and the problem is diagnosed, then the solution is where they come to the asset managers to fulfill. So we are like pharmaceutical companies, and there are several pharma companies. You can, pick and choose any product, combination of product, to eventually help the investors meet their goals. So those are some of my opening comments and some of my thoughts on this question. Over to you.
Thank you, Akhil. That was quite an insightful answer. And taking the analogy, let's go to the doctor now. Let's talk to Renu. My first question would be that, again, how this is also coming from an asset manager point of view. Now, as a financial planner, how important do you see asset allocation? How important role asset allocation play in the financial planning journey of a client if we are helping the client meet? So what is your perspective on this? You are muted. You are muted.
So thank you very much, Anshul, and great to be here talking to other CFPs and aspiring CFPs. Always a great opportunity to share what we have learned over the years and hopefully find more practical solutions. So coming back to your opening comment, Anshul, you said, they are the product side and we are the doctors, they are the manufacturers.
Yeah.
And maybe you can put it that they are on the sell side of the industry and Akhil is on the sell side of the industry and we are on the buy side of the industry. Having said that, it doesn't mean that these are opposing parties. It just
That-
means these are complementary parties and they're able to use each other's presence in the environment, make good business for themselves, but more than that, help clients and investors achieve what they set out to achieve. So as a fund house or a fund manager, Motilal Oswal, or for that matter, any other fund house, cannot cater to individuals. It is not in the model. They are working with the bulk. They work with one strategy of, say, a large cap fund, and then they work around that. Whereas when it comes to a financial planner or a RIA that we are, or the fiduciary advisors who provide holistic services to the client becomes the hero and not the product. Now, when the client is the hero, then we need to look at what is it that's going to work well for the client. And once we start the question from there, then comes everything else. That means what is the economic or the environment, personal environment, economic environment around that client's life? What are the products that are available in the market for that particular client? What is it, the final mix that should go to the client? So when we come back to the same doctor and patient analogy, the medicines are there, but which one to give? Is crocin better, or a dolo is a better deal right now, or a crocin painkiller for that matter? Right? And that's where a CFP adds immense value to their client's life. The problem happens when we talk about these asset allocation. We all understand diversification is good. We all understand debt gives stable returns. We all understand equity gives volatile but higher returns. We all understand gold covers inflation. We all understand what real estate does to us. How much and what should be the mix, the final mix in a client's life? Can that mix continue from day 1 to day 100 of the client? Should that mix be changed every 1 month, 2 months, 6 months, or 12 months, or 5 years, or just don't do it, fill it, forget it? So these are the questions which become more important than just what exactly asset allocation is, because primarily even within the market and within the clients, they're all able to comprehend this part, that we put together different kinds of assets with different correlations, and overall the volatility of the portfolio will be less. Even us as practitioners, we look at it that we put equity, we put debt, we put all the instruments together, volatility or the standard deviation of portfolio comes down, but the returns still stay almost as equal as equity over a long term. That is what we set out to achieve. But how do we achieve? And that is where asset allocation techniques or the theories that we study theoretically, and that's where I'm bringing back CFPs to their classroom, that it's equally important that what they learn in the theory and then be able to implement and use it in the practical world. When I did my MBA in 88, so there were only 3 theories which were propounded. I'm sure even at that time, people who were doing holistic investment management, financial planning was not spoken about at that time in India. But all those people who were doing investment management or portfolio management for their client, they were using not only those techniques, but beyond that. Right now, we all talk about almost 6 asset allocation techniques. And then, how do we use them and within a client's life cycle? So later, maybe, I'll share a few of the slides which the audience may find useful. So putting together different asset classes around the client's life is the most important thing. There is no use of having the money tomorrow when I need it today for the hospital. It's like old Devanand movies. जब मेरे पास पैसा था, जब मेरे पास माँ थी तो पैसा नहीं था, आज पैसा है तो माँ नहीं है. So we want both the things together, and that's what is the most important part, and that's what is the most important role that asset allocation plays in the life cycle of a client.
Thank you, Renuji. This is wonderful thing. We'll be wanting you to expand on this sometime later in the session, because as you said. So my next question is to Akhil, and that is about, he talked about the 2 kind of fund, multi-asset funds and balanced advantage funds. There are specific schemes. And he also said that these flexi cap or multi-cap funds, are they also dynamic asset allocation funds? And if yes, if talking about asset allocation, that asset allocation decision has to be taken, which asset class to increase, which asset class. So do the performance, how do we measure the performances, and how do we measure the relative performances of the asset classes, and how the fund managers go about that? One thing I would like to add to this, like when we are talking about the fund manager of a scheme, he or she is primarily driven by the scheme objective. So how much independence then is there also there? Like I have to ask, I think two different questions in this. So the first would be that how do we decide that this is the time for one particular asset class? And if some insight could be, and my second question would be that how much maneuverability does a fund manager have alongside scheme objectives? Like,
Yeah. So let's say take an example. Take example of multi-asset fund, multi-asset
okay,
allocation funds. Now, typically, if you
okay,
see, most funds would give a fixed allocation of 10 to 20% to commodities, essentially gold. Essentially, gold to I think some players also give silver, but this is a fixed allocation at all points of time. 10 to 20% is a range where it's a static allocation to this one asset class. Now, the greater part of the work done by the manager, both using quantitative tools as well as qualitative tools, is to ascertain that how much money should go in equity. Like Renu mentioned, equity is one asset class which has the potential to give higher return, but is extremely volatile. Extremely volatile, right? So there is where real skill sets and appropriately allocating right allocation to equity is very important. So for that, we typically use quantitative models. So now different managers will have different models. We have our own model. We call it Motilal Oswal Value Index. Basically, we look at PE multiples, we look at price to book, we look at dividend yield, and then we look at long series of data. We take algorithmic mean, and basically we made a quant kind of a model just to ascertain that let's say today we are at 23,000 of index, X is the P multiple, and therefore at this level, what is my value index reflecting? And let's say, for example, today it says that 55% should be in equity, right? So whatever you own, 55% should be equity, 45% should be typically fixed income. So once you have, you remove your 10% gold, now you have your 90% kitty. You use your quantitative model and decide whether you want to put 30, 40 or 50% into equities. Once that equity, which is a volatile asset class, you have ensured that you are giving only that much allocation which is needed at today's valuation, then the remainder is the easy job. Fixed income is always very easy because you just have to buy some
there's
CP,
no
some CD, some G-Secs, and not get too adventurous on the credit side. So you will get your 6-7% from the fixed income, 10% static allocation to gold. Now the whole the denominator is basically the numerator part is basically the equity side, right? So like I said, a quantitative model to get into how much to which asset class. Now qualitative side comes, which is where the freedom of the fund manager is there. How much of large cap, how much of mid cap, how much of small cap, again depending on the valuation, which sectors, which stocks, all of those things is where the creativity of the fund manager comes into play. So allocation done by the model and selection done by the skill of the fund manager. So that's the answer to your first question. The second question was, I'm sorry if you can repeat.
The second question was that how much maneuverability that a fund manager has to change the asset allocation, or he has to play within the asset class. That's what I am asking.
So talk from in generic, I think there are many. I think practically most managers have this kind of a product which is there in place. I would say that without naming anybody, there are asset managers where there is enormous flexibility. Enormous flexibility. So they are not completely dependent on the model. They take their own views, own calls, and they can change. They can go beyond the model itself, right? But few players, including ourselves, I can say that we are little, kind of stricter in terms of the model because model has been back tested properly. So we want to remain in the model. So that allocation part, we don't allow too much of maneuverability. But within that, on the selection side, the flexibility part is given. So again, it's different managers, fund managers will have different ways of dealing with this.
And are there any things like if the asset allocation will change? We are talking about dynamic asset allocations. So the asset allocation will change, the risk profile of the product will also change. So uh, eh, are
Yes.
there some guidelines of SEBI or the investors have to be careful? What would you say from that point of view? Like say
So
if say Mhm.
SEBI has anyways put, I mean, most of the equity products are anyways put in the high risk. So there is that riskometer
risk.
which has been put in place. So most equity funds or funds with higher equity exposure goes into high risk or very high risk kind of this thing. And, so that part SEBI has done. But on the product side, then within that, I don't think there is any minute definition which is happening per se.
Okay. Thanks a lot. Thanks a lot for your insights. My next question, I think, would be to Renu ji. That as part of it, I last in, do you see asset allocation as a crucial factor? Like when you are making a financial plan for somebody, you will be looking for next 15 years, 20 years, 25 years. So would there be a long-term strategy where we'll be stick to the asset allocation or we'll keep on changing it? And if you are keeping changing the asset allocation, what do you do about the risk profile of the investor?
Exactly. So that's where most of the planners or the investment managers of the client, they add value, because asset allocation is, there was some theory which said that 90% of the returns are explained by asset allocation
Asset
and all
allocation,
that.
yes, yes.
That
It was a
there is
research in 1990s, right?
exactly.
Yes.
There are few things which are still hidden in that research, and we have never spoken about it. So besides that point,
Yes.
the reality is that the asset allocation is what is able to give final returns to the client. Now, it is not just because of the asset cycles. The biggest aspect that asset allocation is able to manage is the behavioral aspect of a client. When there is a reasonable asset allocation, portfolio becomes less volatile. Client always have money for their emergencies or anything else that they want. So their portfolio becomes resilient to things like COVID crash, or 2016 demonetization crash, or even 2008 crash. As a matter of fact, COVID crash was bigger than 2008 financial crisis crash. That is one major factor which asset allocation adds to a client's life. Second aspect is when we are able to take advantage of different techniques, and whenever time permits and you'll allow me, I'll show it to you as well, that at every different stage of a investment cycle, a different asset allocation technique gets used to get most productive results. For
You can
example,
do that now, like if you would like to show
can I
some.
do it? Yeah, okay. I'm
Yeah,
gonna
you can.
share it right away. Can you all see this now?
Yes, yes.
Yeah. So there are now 6 techniques which asset allocation theories, which are usually being propounded in different places, textbooks, and everywhere. And actually, they're very good in a way that we are able to incorporate them in our day-to-day practice as well. We start with integrated asset allocation theory, which is probably the latest of all, because that's where behavioral aspect gets incorporated in traditional numerical finance or the number work. So that's the first thing. Now, once you incorporate that, how does it work? On a very basic level, risk profile and goals put together. That is where both the things get balanced. So this is the beginning point of asset allocation for a particular client. Based on this, then we move on to the second factor, which is client's financial status, his numerical details of income, expenses, assets, liabilities, and all the other things that we can talk about a client's financial life. And these factors get incorporated, and you are able to create what you call a strategic asset allocation. Now, with strategic asset allocation, at a base level, a young client or someone who doesn't want to really do much, they can actually continue with it for a while without really damaging their financial life. They may not get too much of alpha out of it, but they'll still be safe and they'll make reasonably good money. The next step comes when we incorporate another factor to it, and that is the macro environment, the current macro environment, and your business cycle, asset cycle, what Akhil was also talking about. The other day, US did good for a decade, China did good, and now we think India will do good. So these are all dynamic asset allocation, the factors which get incorporated in dynamic asset allocation, and the third factor gets added, and depending on the client's risk profile and their financial goals also get added to the risk profile, you do this tweaking of strategic asset allocation. So suppose strategic asset allocation based on all the financial goals put together was working out to 60-40, but the equity market is very cheap. So then you make it 75-25 or 70-30, depending on the client's portfolio profile. The second aspect within dynamic asset allocation, if you can put it, is short-term calls of tactical allocations, which are 6 months, 1 year, 8 months, depending on what kind of an asset manager you are. The fund houses take calls of 1 month, 2 months, 3 months as well, whereas people like us who are doing holistic management for our clients, our short-term call is 1 year. For example, right now we are taking gilt calls on long-term bonds or gilt, because the duration, the interest rate cycle has reached a certain level, and we think that people will make money. Now, this tactical allocation is something which gives that what you call the garam masala on the regular vegetable curry, because that's what adds the spiciness to the portfolio. If the calls are correct, it can add on, to a couple of percentages extra to the portfolio return, even over a longer term. And shorter term, of course, it gives very good returns. But this is something which you got to be very careful. Who can take that risk? We may take a call of gilt fund, interest rate cycles changing after 3 quarters. They may not happen for 6 quarters. Does the client have the resilience to hold on? Or if it goes in the other direction, how much the client can endure the risk? And that is what becomes one of the most important things if you use this, when you are applying this technique. Apart from all of that, you have and we use this particular strategy very regularly with all our retirement clients who are living off that income of their retirement portfolio income, that in consultation with the client, we fix a base value. That, okay, we are starting the portfolio with 3 crores. In no case should it go down below 3 crores. And then we take, chances and volatility risks and all that. Suppose it comes to, say, 3 crores, 10 lakhs, and we see the market not doing good, and, we may fear something not going to be right. We give up that greed of extra alpha, take the money out, put it in fixed securities, and maintain the value. So the bottom line of the portfolio is managed, and that's called insured asset allocation. Extremely important in retirement portfolios and other clients who are risk averse, very risk averse. Constant weight allocation. In our place, we constantly use it for rebalancing. So every 6 months, we look at the client's portfolios and see if any rebalancing needs to be done. That's where we use constant weight allocation. Now, constant weight asset allocation is able to help us out, that your equity has gained. Let's take out some money, help with those capital gains tax exemption, and give good returns to the client. So what happens when we put together all of these strategies at the right stage with the right input? We have a result which will never disappoint the client or the investor. Most of the regular investors are not in there to gamble or to get excitement. They're there to create long-term wealth security. And these strategies put together, applied in a proper manner, always does the magic.
Thank you. That was a wonderful presentation, I would say. Gave us a lot of insight and answered a lot of questions which I was planning to ask. So I'll have to.
Thank you.
So you have already answered a lot of questions that I was going to ask. Okay. Now, since we are talking about risk and return, that these are the two most important factors. Now, from a financial planning perspective, from investment advisory guidelines of SEBI, we know that risk should be the driving factor. First, you decide that how much risk you are going to take, and then the return comes alongside. However, if I want to know from the portfolio manager or asset manager side of view, is it still like that risk is the guiding factor or return is the guiding factor? That we want return and this is the risk we are going to take. For an individual, it is clearly decided. In financial planning, SEBI doesn't allow us SEBI says risk would be the deciding factor. But from a fund manager point of view, is risk the driving factor or the return the driving factor in this? It's only a little. This is
Yeah.
my
So
personal
yeah.
question. Yeah.
Yeah, no, but it's a good question. I think it's I think first time somebody's asked this kind of a question, but relevant question. From a fund manager perspective, I would say that there is a fine balance between risk and return. Obviously, the industry is very return oriented. So, for fund managers who want to, I mean, from business perspective, if we have to grow, we have to perform. Now, for to get the performance, and then performance is also evaluated at multi levels. Now, performance is first you perform, right? So first is that you give positive return. Second level of performance is you beat the benchmark. Third level of performance is that you beat the peer group. Fourth level of performance benchmarking is, are you in the top three? Now, as an asset manager for last 24, 25 years, I've been in this industry. Eventually, bulk of the investors' loyalty goes towards the top three funds. Now, if any business has to grow, if any asset manager, any scheme has to go, you have to somehow, if not top three, because nobody controls that top three, but everybody is dying out chasing to be in the quartile one, quartile two, at least quartile one, quartile two, somewhere there, to get some commitment from the investors, right? So performance is extremely important, but it cannot be at the cost of undue risk. Of course, there are a lot of regulations as to how we manage risk internally, but clearly we have a lot of risk control. So, like I would say that when you create a portfolio, there are two parts of creating the portfolio. There is a selection, and there is an allocation. Right, so selection side is where your skills come in play, where you decide top down, bottom up, which sectors, which themes, which stocks, all that stuff. Right. The other part is the allocation. Allocation is where the risk controls come in place. Right. So now, obviously, you would want to give higher allocations to companies where quality orientation, growth orientation and valuation is very, very reasonable, right? So because if you have to if you have to protect the downside, you need to up your quality quotient. So if you compromise on the quality, then there is a problem, right? So most managers would ideally try to will talk. Actually, if you listen to the commentaries from most managers, they will always first thing they will talk is we will create a high quality portfolio. Now, high quality portfolio would be good business, good management, companies with very high ROEs, ROCs, low debt. So all of these things basically is done to ensure that the downside is protected as far as possible. Market related downside is one thing, but mistakes have to be avoided, right? Now, within the quality quotient, you have to chase then growth, which companies will give high growth, because that will determine how the returns will shape up. And if you can buy quality and growth at the right price, then you get the, that delta of, really being really having the right to win, that kind of stuff. But certainly, I would say, at least when it comes to me, and I'm sure for the industry, everybody thinks about downside first, risk first, save the capital first, and then talk about returns. And therefore, especially when it comes to equity products, we always put disclaimers. If you're coming into equity, I mean, you have to come with a starting point of 5 years, 10 years, 15 years, depending. I mean, when we talk about small caps, I typically say that come for more than 10 years. If you're looking at large caps, maybe you can look at 5 years also, right? So that long term is the biggest hedge, I always say, to protecting your downside. But from the fund manager's perspective, clearly there are very strong risk controls. How much you allocate per stock, how the overall portfolio, how thinly are you constructing it, or how you manage the risk per stock across a portfolio of 50, 60 companies, sectoral level deviations, profit taking frameworks, so there are many things which go in place to primarily ensure that with the lowest possible risk you give best possible return, which is where all these ratios also come into play, the standard deviation and beta and Treno and all of these numbers come into play. So of course it is a balance, and I'm sure most managers would be interested in, otherwise you can't survive, right? So return is also important. At the same time, risk is also important, and
return is
that
extremely
equilibrium is
important.
where
Yeah.
everybody's trying to achieve. Yeah.
Why I was asking this, because as financial planners, it's our fiduciary responsibility to safeguard the interest of our investors. So we are investing in schemes. You also have to keep an eye as to what
Yes.
the fund manager is doing.
So
One more
I would
question
say
to
that
you.
a financial planner like Renu, her job is not only to manage risk. I mean, of course, the fiduciary responsibility is to manage the risk for the clients, for the investors. But in order to do that, I'm sure when she's doing selection of the funds, she would be probably going into such detailing where, you know, which fund has a lower beta, or which fund has higher quality, or which funds had lower standard deviation. I mean, she will be doing all of those things, and that in a way then tries to, with the objective to protect investors' capital.
Absolutely.
Or reduce the volatility.
Yeah, I like one more thing, Akhil, to that. We also look at the fund manager's personality to match it with the client's
That is a very
personality.
important
Absolutely.
part.
Absolutely. Yes, very, very important, because there are great fund managers, but they would be very aggressive.
Yes.
They might give very good returns, but it may not suit some set of investors for sure. Absolutely agree with you completely.
Right.
Yeah.
A very important question that needs to be asked, and that's a difficult question to answer. When MP says in its campaign that mutual fund sahi hai, but kaun sa sahi hai, that's a very important question. That's why you're talking about dynamic asset allocation.
Yeah. So
That
Anshul, to give that answer, kaun sa sahi hai, all CFPs make their earning out of it.
CFPs make this thing out of it. That's what I do.
So FPSB can probably run that campaign. Kaun sa sahi hai, go to a CFP.
Kaun sa sahi hai, go to a CFP. Yes.
Yeah.
That would be that is a nice suggestion. We can do that. That brings me to another very interesting question somebody asked, that can we say that dynamic asset allocation is an active strategy? Like active strategy, if it is an active management strategy, most of the times the returns are from specifically balance advantage fund I'm talking about. The returns are not that high. Okay. So would you say that dynamic asset allocation is a specific case of tactical asset allocation, and is it aggressive, or it is a passive, or not? I'll not say passive. It's a
No, let's be
defensive
clear.
strategy.
Let's be clear. Dynamic asset funds or BAF funds, they are all active funds. There is activity
That's
which
right.
is going on into the fund,
Yes,
whether it is
that's right.
rebalancing portfolio between multiple asset classes. Within the asset classes, the actual instruments what you bought, whether it's stocks, whether it is bonds, there is activity which is going on all the time, right? So definitely they are in the active bucket. Now, typically, balance advantage funds or multi-asset funds are positioned to basically outperform fixed income by a few hundred basis points. It could be 200 to 400 basis points, depending how the fund has been positioned. For example, there are I'll not talk about Moti, but there are few multi-asset funds which are positioned for debt-oriented investors. There are few multi-asset funds which are positioned towards equity-oriented investors. So depending on the objective, things will look very different. Now, when it so basically, we are really not trying to see what the benchmark returns are there, all this stuff. We are just trying to see that over a 3-year, 5-year period, can I be towards the stated desired return objective, which we have kept in mind, which could be 9%, it could be 10, it could be 11. I think nobody will talk about giving 15-20% return in a BAF fund, or it's for moderate. BAF is for moderate risk investors, and multi-asset funds are for one notch below moderate risk also, I would say. There was a question which I saw, and I'll complete that question also, which is that most of the time multi-asset funds underperform. Now, basically, this underperformance or outperformance comes because there is no right benchmark. I mean, typically there are some standardized benchmark by CRISIL. In case of balance advantage funds or hybrid funds, it's CRISIL 50-50, 50 equity plus 50 debt. Now, in my balance advantage fund, equity could be sometimes 70%, 75% also, and the benchmark is at 50%. So there could be this anomaly. I think this is one category where one should not really look at the benchmark, but look at the absolute returns, what you're targeting over a period of time, and then kind of ascertain whether the fund has lived up or not lived up to the expectation. I've killed one question actually as I spoke.
Yeah, that's wonderful. Renu, some live question. Looking at the current market situation, what will you tell your clients now? That people who were young when you started with the strategic asset allocation for them, and in the last 6 months, we have seen our markets are doing tremendously well. Equity markets are doing well. So, what will you tell them? Should they increase their allocation, or should they wait? What is the
So,
And what will be the basis of it? Why will you say that?
okay. So, Anshu, like I said, that strategic allocation is based on their financial goals. For example, I'm just taking one goal. For example, a 30-year-old person who's going to retire at the age of, say, 50, the goal is 20 years away. So 100% goes into equity. Then, so this way, then we club all the goals and find out the overall strategic allocation, right? So that is the first way, or how to decide upon strategic allocation. Go by individual goals, see what is the right thing, club all of them. That's the first step. After clubbing, then you look at their risk profile. And suppose the risk profile is conservative and the strategic investment is saying 70-30, your allocation is saying, you cannot give 70-30 right away to the client. He'll not be able to absorb. So then you sit with the client across the table, explain the realities to him. Say, okay, we are going to start with 50-50, but let's get geared up to move it to higher level. Right? Now, that's where the expertise comes in for all these clients who are on that side. And I'm just taking one kind of example. When you are looking at, say, post-COVID market, post-COVID, the markets had a run-up for 2 years, 1.5 years. By the end of it, plenty of people were coming in the market. And we all who were in the market knew that market is not going to give this kind of return for next 2-3 years.
Forever. Yeah.
And that's the time that you got to take the call based on the client's behavior. So in our case, what we did for all those clients were looking at their risk profile. We strictly stuck to their risk profile and said, see, don't expect so much out of it. But for the similar clients, and they were little not so happy, obviously, because the money was not made. When we realized that now the market's going to have a run up, we went back to them saying, we are doing your reallocation. And that's where the dynamic asset allocation comes in. That's where you take the market calls, because then you can see it, that it's going to happen, and you move it. So they all made very good money. Right? And that's how we can't change the allocation today. We had to change it yesterday. And that is where the planning and some bit of a market macro environment understanding, and of course a lot of help from research of the fund houses, because they've got plenty of resources to do those kind of researches, and that helps us. That is where the call had to be taken yesterday, not today. And all CFPs and aspirant CFPs should focus on that, because by the end of the day, our plan, which is on paper and doesn't give result to the client, is a popo, plan on paper only. It doesn't have any purpose in life. They will give you 25,000, 30,000, and when they don't achieve anything, it's like, okay, there's no use of this financial planning. So you've got to stay with the client, help them take the right decisions as the times change around. So this is the basis. Your macro environment calls are a very good indicator of when can you take the call. Don't take it wholeheartedly that, okay, the markets, we think equity is going to do good and 90% take into equity. No, still stick to the something around the risk profile, and definitely never forget the goals, financial goals and financial status.
I think very well
answers your question.
I think very well, but I just want to add on a point is that most financial planners, I think the larger goal is basically to manage behavior of the client rather than actually managing returns. Returns will come, eventually it comes. But like she said, during COVID, post-COVID, people get excited and then they get disappointed. So how to manage the behavior in exciting times and equally manage the behavior in bad times. When the market tanks 40%, how to manage the behavior, and when the market goes up 100% in 1 year, how to manage the behavior. I think the way she has explained is very beautiful, because she identified the clients where behavior can be managed and they stick to the asset allocation, but those who are really feeling the FOMO kind of a effect, then at the right time you increase the allocation. And that's the beauty of this whole profession, which is financial planning. It is so, on the 360 view, it will look very passive, but actually it's very active. If you go down at the portfolio level, I'm sure Renu and people like Renu are extremely busy every day, because we are in a world which is so dynamic, especially in the last few years. You have seen, usually black swan events happen once in 10 years. Now we have seen Three black swan events in 3 years. You saw COVID,
Yes,
you saw
yeah.
Ukraine war, we have also seen the Israel-Gaza war. You have
Yeah.
seen economies collapse, global economy coming down, interest rates going up, inflation's going up. There's a geopolitical crisis. There is some, Red Sea issue. There is China issue. There's and it's a very tough life for financial planners to still, figure out that how to manage risk, what could be the potential threats, and then what should be the right asset allocation for the right people, and then within that, what needs to be done. So, guys, I mean, at least the investors who are out here, I mean, we have to give full credit to it's not investing is not easy, I would say. You need professional help, and for professional help, you need certified professionals rather than non-certified professionals who have the expertise to navigate you through and to manage your behavior. I mean, what doctors also do is nothing but, if there is a big surgery going on, the way they will do the surgery, at least the good doctors, they'll not scare you that this injection is going to pain you and I'm going to cut your heart and it's going to create this much pain and 6 months you're going to be, they say kuch nahi hai, kuch nahi hai, kuch nahi hai, and they'll just do it. बाद में pain तो होता ही है. But so that I think it's a profession which is very understated, honestly. I would urge, actually, at least I try to do that. I mean, myself personally, I can say that I take help. I don't do direct, except for regulatory. I have to invest. My salary is deducted by 20% because of regulation. But all my investments are basically through two financial planners. I don't interfere. I don't know because I find only Motilal is good, so I end up putting everything here. So they do the diversification part. So anyway, but I think Renu, you put that very beautifully here.
No, thank you for that. Actually, I would agree with Akhil on that. It's a very undersold profession. And that's what constantly through Arya and through all our advocacy and interactions, we are trying to, bring this thing to the forefront. And I saw the question, they asked the question, how do you look at this macro environment and how do you learn them? So for those students who are actually interested in learning that, this is a very, very important aspect. First of all, you read your textbooks. First of all, understand the terminology. After that, start taking short-term calls and long-term calls. Make a note of it. Then go and recheck. Could you read the things carefully in the market? Could you interpret people carefully and in a more intelligent manner? That's a tip for the students who are there in the audience. And secondly, for the
professionals.
Sorry?
For the professionals, they also need to update themselves.
Exactly. Yeah. So for the professionals, look at who is talking what. Look at the background of why is that person talking that. So no offense, Akhil, but if Akhil is talking about mutual funds, take it with the grain of salt. I'm not saying anything that he said otherwise, but I'm just saying. So if an insurance person is talking about something, take it with a grain of salt, do a cross-check, and then make your inferences. When you have these indices which your fund houses and all other people give out to you, understand what is the basis of that index. That's a complicated number that all of the fund houses churn out. What are the basics of those numbers? What is the value driver of that particular number? So do you keep an eye on that is that assumption true in the market? If at any point in time you feel that assumption is changing, you can change your decision and look at some other parameter. So that's my tip to.
In my thing, fund fact sheets of mutual funds are a very good source of information. In the first, don't go fund fact sheet that produce the research and all. They're very good. You will find macroeconomic data there.
Absolutely. Wonderful macroeconomic data. We also depend on them to give us that data.
Okay, so we are coming to the close time. So let us take some questions from the audience, if that is okay with you. First question, Akhil has already answered. Why there's a question from Rajkumar why most of the DA funds are not able to beat category returns. So I guess Rajkumar, your question is answered only. Another question is from Anuj Kumar. He's saying, does fund manager take care of the standard deviation, beta, etc. at the time of selecting security, or these are calculated after building portfolio and declared? I mean to say,
it's post facto. Nobody has. It's not possible to, it's only after you have done it, and there are some numbers out there. Can you go back and see what the standard deviation? And then you can see that, okay, how you want to manage this standard deviation business and beta and churn and all those things. But these are all post facto numbers. It's the style of the manager. I mean, some fund managers may have high beta portfolio and still end up giving very high returns. So you just have to go play along with that. Some managers may give high beta portfolios, low return, then there is something to think about, right? So, but yes, I mean, keep the answer short. I think these are after once the portfolios are created, these numbers play out.
Okay. So I guess Anuj has got the answer. Next question is Abhishek, and I think it is for Renu because he's asking, as a planner, when we meet with investors, their first response is always to show as risk seekers. But as soon as the market corrects, they become risk averse. This is a very interesting question. How to deal in this scenario and get the right risk allocation for such investors?
Exactly. So it depends on the environment you're meeting. Right now, everyone is a risk seeker today. And just 3 years back, everyone was risk averse. Now, as a practitioner, what should you do? You need to be confident enough to stick to your guns. If you have to let go of a client, my suggestion is let go. If they are so adamant and do not listen to you. So first of all, be confident in what you are going to suggest. Second is, if they are not prepared to listen to you, let go of them. This is a country of 1.4 billion people. To run your advisory practice, if you have 100 people in your clientele, good 100 clients, you will have a good practice. Don't get a client who is not going to listen to you. You will always be struggling with it, and you will not be able to give results. So try to do it. Show them their behavioral pattern. Show them the numbers of past. But in case, even if then they don't get convinced.
Absolutely, all clients are not your clients.
Absolutely.
So you need to pick and choose your clients, and those clients who listen to you and who believe in you, and then is where that mutually you can meet each other's goals together in life. I agree completely.
My experience has been reverse also. Initially, people become risk averse, but when the market becomes bullish, they become day traders.
Yeah. No, it's a normal human behavior. It's not. It's investors across the world. I'll tell you one small example, just small example. I mean, how much are we risk on? We did a small cap fund in December. We raised 1,400 crores. We did a large cap fund in January. We are struggling to cross 400 crores. Today is the last day. Now,
people are risk loving now.
So,
this is a typical example. Wonderful numbers,
Let me share a little thing. I was in one of my sessions, I was saying that there are more than 10 crore crypto investors some 1 or 2 years back. I can't believe that. Somebody in my experience said, what are you talking about? There are 14 crore people on Dreams 11. Dreams 11 claims that.
Yeah.
So those people in the stock market. So,
the funny thing is that large caps have also given return. So if you see last 3 year CAGR is 28%, mid and small is in the range of maybe 35-40%, but because 35-40% is higher than 30%, so 30 looks bad and 35-40 looks good. Therefore, higher investment into small and mid. वो भी होना चाहिए. I'm not saying not, but
No, I got your point, and that's a very interesting data point to show how clients behave. Although we are all saying that large cap will do comparatively better in the coming years.
Yes, absolutely. In fact, while we are on Q&A, I also made 2-3 slides, but just to show all of you that how difficult those who are CFPs and aspiring CFPs and investors, I'll show you 3 slides what actually the CFPs are dealing with for all of you out here. Just allow me to share. Who's
Sanya, can you allow Akhil to share the slide?
Renu ma'am would have to do that.
Oh, sorry.
Okay.
If you can take the post to Akhil.
Yeah, just very quickly. Since I did some work, let me do that.
So I have allowed you, Akhil.
Thank you. Now this is what me, Renu, Anshul, and Sanya, we were all discussing yesterday. So I just 3 slides to show you the complications of asset allocation. Now, basically what we are saying is that every year, every month, every decade, all asset classes don't perform linearly, right? So some years, some decades will be some asset class, some years, some decades, it will be some other asset class, right? So the challenge is not the most easiest thing is to pick and choose or allocate basis what has worked in the past, but the challenge is actually to ascertain that what will work in the future. And if you cannot do both, how much to do in the past and how much to do in future is where the asset allocation comes in play, that you put something in everything rather than putting a lot into something, right? So in a simple, now you see this slide, very simple slide. Every 10 years you have one best performing asset class. This is in the global context. Now the decade of 70s, so 1970s, 1961 to 1970, gold was the best performing asset class. In those 10 years, whoever put money in gold made 13.7 times. Okay. Whereas US gave a 15% return in that 10-year period. But next 10 years, gold gave negative 35% return, but Japan gave a 5-bagger. In the next 10 years, Japan gave a 3% return, but US gave a 5-bagger. In the next 10 years, I was surprised to see India has been the best performing asset class. While we were the fragile 5 economy, but our stock markets gave the best returns. We were 5-bagger. US was 7%. Last 10 years, 2020 decade, US 2.3 times, India negative. And any guesses for current decade? You can think. Okay, now this is what I liked in the Mint very recently. This was published. Now these are 10 calendar years. Okay, now you see every calendar year the top 3 or the top, let's say for 23 small cap was the best, 22 gold was the best, 21 small cap was the best, 2020 was small cap, then it was international in 2019, and then it was gold again. So for those who feel, and it's been a learning for me for many years in my presentation seminars, I used to say that gold one should avoid, gold is inflation, and it's a bad product to be in. I've actually started telling people, I'm thinking about myself also, that we should have 10-15% gold, because 2 out of 10 years gold has given the best return, not the quantum of return, but in bad years it will save you. Right, and that itself over a longer period will add some delta in your portfolio. I was surprised 5 out of 10 years small caps have given the best return. But who gets this best return? Those who come when they give the worst return.
Worst return, yeah.
See, we in asset allocation, the idea is to have that counter cyclical approach. So while you do a overall asset allocation, but then where to go overboard, underboard is where the valuations are looking very, very attractive. So, but the limited point is your top 10 returns, it keeps changing every 10 years. So all CFPs, aspiring CFPs have to work to figure out that how the asset allocation should look like. And finally, this is our own internal slide. This is where the most mistakes happen, largely with the investors, is where we end up chasing the best asset class. Within the asset class, we end up chasing the best performing product. And if you look at this slide where, let's say between 2012, 3 years, the number one performing equity fund in the next 3 years became 123rd rank. Okay, so when you are buying the best performing product of the last 3 years, you are buying after the performance is gone, somebody else has enjoyed that, and you're coming at the top, and then you go through the bottom. That same fund will give you return, but then your waiting period will elongate. You'll have to wait so the returns will be very back-ended. But so then we have to decide that we don't have to decide by returns in descending order. We don't have to buy asset classes by descending order. Within the asset classes, products by descending order. Exactly. You have to buy reverse.
Yeah.
Akhil,
I'll take these slides.
Okay,
It will help me convince the client.
I would say those slides are telling why dynamic asset allocation is important.
Yes.
Why
share me your email ID. I'll just email you right away.
Sure.
Okay, we have crossed our time, but some more questions have come. Let's take 1, 2, 3 questions, and then we'll call it a day. I hope that's okay with you. How would you advise for experienced professionals who are industry with 20 plus years? Will CFP add value? This is a question by Puneet Sethi. Since I can also answer that, but I'll ask Renu to answer this question.
Sorry, I missed that.
The question was, how would advise for experienced professionals who are industry with 20 plus years? Will CFP add value?
Okay, so those who are investing for 20 plus years, and if they have come on their own, ask them the question, why have you come? And understand that. If you are going out to sell yourself to them, then you need to be prepared to look at their life, give them those pointers where you think which might be a what you call a touchy point for them, or which is it that's at the back of their mind. So we have a lot of senior clients who came to us. There was one or the other thing they were worried about or bothered about, and they were looking for a solution for them. So understand, CFP is not about investing alone. Investing is just one part of the whole game. You have to understand, why does the client want to look for guidance in investment? Sometimes they have a problem in some other area and they're coming to you in the name of investment. So that is a very, very important aspect. Understand where do they need the help, and then position yourself.
One question from Ranjan, I guess. How relevant is looking at the fund PE, as many research websites publish the PE of the fund too? Also, I'd like to know that one of my clients wanted to invest just in ETF. That is a very interesting thing. Whereas I recommended him a portfolio of active funds, and my suggested portfolio provided far better returns even after having more weighted expense ratio than ETF fund. Should I recommend that active fund portfolio or ETF portfolio with low self-expense? Now, this is a very interesting thing because there's a lot of focus on passive investing in ETF. So, that is,
Okay.
Whom
do you
it
want
was
to?
a long question. Actually, I got a bit lost.
Yeah, let me show.
Can you put in 2 lines what you understood?
Yeah, what I understood was that he was advising client active portfolio, and his client was insisting on ETFs. Okay? Active portfolio gave better return despite having a higher expense ratio. So what should he suggest? That's what.
Yeah.
Yeah, maybe Renu, I can add.
Okay. So see, look at the data points and be very honest with your client why you are doing what. So you are, and I'm just assuming this is a CFP and not just distributing. Even if you're distributing, stick to the right things. So suppose the client has come to you, which is for a large cap ETF, for index ETF, and he's comparing it with regular large cap funds. Most probably he's right. Most probably ETF might be a better answer for him. You can go for an index fund, which has got a very low expense ratio, and probably look at that. But be honest with the client. And we are seeing, it's not that active management has got no place in the market, but we are seeing where passive investment also has some value. So clear yourself in terms of return numbers and expectations, and then talk honestly to the client.
My answer would be that these are all what do you say, in hindsight kind of numbers, so at different points of time, indices will do well. Some points of time active does well, and when it does well, it doesn't do well by 2-3%. You see last 1 year returns, the outperformances are like 10, 15, 20%. Right, which is the journey probably this person would have actually lived through. But there has also been a time like 21, 22 where outperforming the markets had become like a hell of a job. Right, so probably those points of time passive investing was looking better. But I think incrementally, while I do feel that India is an alpha market, definitely we are still emerging country, and there are a lot of businesses which are still under researched, and fund managers can add value, identify new businesses with high growth rates, and therefore try to beat the benchmark. But as we go and as we move from emerging to developed, and markets, the more and more companies get discovered, then this fight between active versus passive is going to only increase. But we are still quite some time away. I mean, we are not where US is there today. I feel so. But it's happening slowly, steadily. Those things are there.
That's true.
Perfect. Thank you. One last question we'll be taking, and this question is for Akhil. It is written in the question. The question is for Akhil. You mentioned that in case of small cap funds, investors should invest in generally for a 10-year plus period, and likewise in large cap for at least 5-year plus. So my question is whether the stocks in portfolio are bought with that time frame. If not, there is a mismatch, and the time horizon of the fund is different than the investor, and thus the risk taken at both levels is different. How do you
So
explain that?
stocks are not bought for 10 years. I mean, nobody can see, no fund manager can see a stock for 10 years. I mean, stocks are generally bought from a 2-3 year time frame, because the earnings visibility, or more specifically the earnings visibility, you can only gauge for 2-3 years, while business models and all that stuff you can see, look for 3-5 years also. Why I said small caps for 10 years? Because small caps are generally smaller companies by market cap. Generally, they are illiquid in nature, so largely owned by promoters, and free float is very, very limited in the market. So when it gives returns, it gives killing returns because of the same reason. And when times are bad, and some uncertainty comes in, then the stocks can correct also massively, because sellers will become sellers, and liquidity, in absence of liquidity, price just kind of moves down. So small caps are vulnerable. They have higher volatility, and in bad times they can give very sharp drawdowns, and therefore you need to have a longer term horizon to live through one or two of these cycles, such that over a 10-year period you can average out at I mean, approximately, let's say, anywhere between 15-18%. But let's say if you invested for 5 years, and the fourth year there is some issue, and let's say COVID comes in and you go 50% down, then you have to be a 10-year investor. So that's why you need to have a 10-year horizon. If you had a 5-year horizon, and fourth year you go down 40%, and fifth year you need money, then you're gone. That's the point I was trying to. Whereas in large cap, the drawdowns are lesser, and the recovery is very fast. So even if you see the 2020 correction of 40% in Nifty 50, it was lesser than mid and small cap, but recovery happened within less than 9 months. We came back to same levels within a year's time. Whereas small cap, mid cap, so they have come up now. The level of 2017 has crossed just 7-8 months back. Right. So that's the reason why I told you small caps. I'm telling you, small caps need to be 10 years and more. Anything less than that, you have to be lucky.
Thank you, Akhil. I think I will keep the questions to that in the interest of time. So if you want to make any closing remarks as to what would you like to suggest financial planners or investors for a small, that is okay.
So
Then
maybe I'll
we'll-
come in first, and then Renu can conclude.
Sure,
So
sure,
here I'm saying that lady should be last. So let her give the concluding remarks, right? So I would just say that I think we are in very interesting times. I think we are all very lucky to be in a country which now is demonstrating some very good signals of secular trends in terms of the economic outlook, in terms of the kind of businesses are coming up, in terms of the growth outlook for our country, in terms of how the macros are shaping up. I think all around, the way we are accepted as a nation, or as a growing nation, aspiring to be top 3 in the world in the next couple of years. We are looking at going to $7-8 trillion by 2030, right? So our country is offering a great opportunity, and these are all like once in a lifetime sort of opportunities, I feel. So and the beauty within our industry is that the savings rate, while the overall savings rate to GDP obviously is high, but there is a greater interest, awareness, keenness to invest in equities and increase their allocation in equities. People are understanding that in long term, purchasing power is very important, and this one important asset class needs to be part of the asset allocation framework. I think we are just about 4 crore investors in mutual funds. I think there are 40 crore people who have Aadhaar and PAN card linked. So we need people like you, CFPs, aspiring CFPs. We need them in thousands and thousands to reach out to 30-40 crore people in the next 7-8 years, and help them in creating wealth and having a great life. Good cars, good homes, good lifestyle, good retirement, good education for children. For that, asset allocation and investing early, investing regularly, all of these things are very important, and therefore financial planners are extremely crucial. They might be bad people at some points of time, but very important in helping you be very, very wealthy in long term. So I'm very passionate about this business, and at some stage when I retire, probably I'll also become a financial planner only. But it's a big, big opportunity, and one opportunity where as your investors will grow, you will grow. I mean, this is a business where your earnings also compound with the compounding of the investors. Right. So it's a beautiful, beautiful place. I mean, infinite opportunities. Just do the right things, right practices, be ethical, high integrity, knowledge orientation, and sky's the limit. All the best to all of you. Over to you, Renu.
Absolutely. So Akhil stole a lot of my lines. Doesn't matter. I'll think of few more new lines.
So I came in first.
I know. So I agree with him. I think we are looking at a wonderful decade ahead. And I tell all my clients, all the people I meet, that in our lifetime, we will probably not see this decade again. So make use of it. Be there in the market. There is a lot of scope to bring people into the market, rather introduce them to the market. What I would suggest to all CFPs and budding CFPs, do not forget one thing. Whatever model you may be following, do not leave client centricity, because any bull run or any good run will definitely be interspersed by crashes and negative events, and people will run away if client centricity doesn't exist. Now, how does client centricity help? Because if you are client centric, you will go for the right asset allocation. Once you go for the right asset allocation, automatically the downside is protected and clients develop resilience and hang around in the market, and then they ultimately end up making a lot of money in the market. So stick to that. Don't change that particular principle. And second is, hang on. Just hang on. I understand, we are not there where we thought CFPs would be when we all started more than a decade back. But this is the future. People who entered into the IT segment, and I just give this example a lot of times, while India was in 80s and 90s, you could see where they were in 2000s and 2010s. They were on the top of their career. People like Chandra and Narayan Murthy, they're the examples, people who walked into the industry. People who are walking into this fiduciary planning and advisory now are going to be at that stage. Next decade belongs to you. Hang on, do the right thing. Forget about the regulations, forget about everything else. Just imagine what the people need. The crowd around you need you. Even if you have 100, don't think about 1,000, 2,000, 4,000 clients. Focus how to get my first 100 clients. You will have a wonderful practice. Like Akhil said, your income also compounds. And I always give an example. Your income goes up in three manners within this financial planning advisory model. One is by increasing the number of clients. Second is as the clients give in new money, your existing clients. And third is the market goes up. So can you imagine three factors compounding your returns, your income? There can be no profession like that. Just do the right thing and you'll do great. So wish you all the best.
Thank you. Thanks a lot for wonderful insight. The discussion was quite, and thanks for your energy also. I could see the energy and enthusiasm both of you. So I guess it would have been contagious, and all our participants are feeling excited. So we have crossed our time. I would ask Sania to conclude the session. Thanks a lot for your valuable time and insights. We'll keep on looking forward to this.
I think you were a great moderator. So you kept this whole session very active, exciting. Thank you.
Exactly. Thanks for the wonderful questions, Anshul. And it's always a delight to be able to talk to fellow CFPs and come back to FPSB. Thank you very much.
In fact, it was a very interesting webinar, first webinar for the year, and it turned out so well. And as we draw the curtains on this insightful and interesting webinar today, I am filled with gratitude for the wisdom that has been shared with us and the active involvement of the attendees today. Also the wealth of knowledge that was shared by our esteemed panelists, Mr. Akhil Chaturvedi, Ms. Renu Maheshwari, and our very own Anshul Srivastava, is a testament to our commitment to providing you with cutting-edge information and strategies. On the behalf of FPSB India team, I would like to express our sincere appreciation to all our panelists for generously sharing their time and expertise and wisdom. To our audience, thank you for your active participation and engagement. As you reflect on the insights gained today, may you find inspiration and confidence in implementing these strategies in your financial journey. I'm also delighted to share FPSB India's commitment to enhancing engagement within our community through various activities throughout the year. One significant step in this direction is the recently concluded webinar today. So as we strive to boost engagement, your active participation, feedback, and support are invaluable. Stay connected with us through our upcoming events, webinars, and initiatives that aim to empower you with the latest industry insights and best practices. So we extend an invitation to each one of you here and our entire FPSB India CFP certification community. So basically, I would also like to inform you that for the purpose of earning the CPD points, the recording of this webinar will be soon made available on your LMS portal. You can earn your CPD points there. And additionally, the video will also be uploaded on our official YouTube channel. And for latest updates and developments, please follow us on our LinkedIn channel. In closing, I encourage you to, as I said earlier, stay connected, stay informed, and continue seeking knowledge in the ever-evolving world of finance. So on behalf of our entire team of FPSB India, we sincerely thank you for your continuous support. Hope you had a great day. So we conclude our webinar here.
Thank you,
so much.
Sanya. Thank you, Anshul. Thank you.
Great,
Bye-bye,
great.
Renu.
Thank
Take care.
you.
Bye-bye.
Pleasure
you.
meeting you.
Bye-bye.
Thanks.
Bye, everyone. Take care.
Bye.
Good luck.
Good luck.